Hello, Oak Bloke here. So we're going to cover Unite and Unite's results. I know I did title my prior video Unite, and I'm going to have to change that and just say that's me chatting about the Oak Bloke picks for 26 because I kind of just thought it would be worth talking about those, but I ended up spending nearly half an hour talking about them. So I thought I'd just keep them separate. Otherwise, just for this article, focusing in on the 2025 results. Anyway, um, Unite is a student halls of residence provider, hence today's picture. And I quite liked the title, Unite, yield to unite, unite. I thought that was quite good. Anyway, right, I'm going to start by just talking about net operating income yield, because I think it's worth understanding some of these terms. I mean, it is quite a specific term to property. So what 5.2% NOI yield actually means, and it's the highest for a decade. And I ask the question because you may or may not know, I mean, this isn't a trick, but is that a good or a bad thing that it's 5.2? Well, the net operating income yield reflects the net income relative to the valuation of the property. So it's a little bit like the ROI, but the I in the ROI of return on investment is kind of what you put in, whereas NOI or net operating income yield is like, well, it's not based upon what you put in, it's based upon what it's worth at the moment. So it's kind of like saying, well, it's, if what you own has gone is now valued less, then the return will have gone up. Because on the face of it, you go, oh, return's gone up, that's a positive. Well, no, if the return relative to what you own and what you own has gone down, the fact that the return relative has gone up is a bad thing. Does that make any sense? Well, you've got to think about it, and obviously on the face of it, understanding when someone tells you the NOI yield has gone up, it's like, well, is that good or bad? Show me what the other numbers are to work that out. Anyway, so you can see here it's increased, and Unite themselves I don't think do themselves any favors by how they explain it, because they just say, oh, the yield movement was this, the NOI yield was that. Um, but what they're actually saying is that the valuations dropped, which obviously is sort of the negative. But when you actually get into the numbers of like, well, why did they drop? Okay. So some of this is stuff to do with fire safety and the Grenfell disaster, and the cost of um, rectifying tall buildings that need their cladding removed and replaced. So you've got sort of about 3p of NAV dropped from that. You've got the aborted planning costs. So it's basically a building they were planning to build. They've spent like the equivalent of 2p of NAV, net asset value, and then decided to bin it off. So they obviously binned off and lost the costs. Some of it was just increased costs. So increased development costs is just, it costs more to build what they built. And then 30p of it was due to 3 cities. I'm going to talk about that in a minute. And then minus 4p was on restructuring, acquisitions, and SaaS implementation costs. Again, that's kind of a one-off cost, really. So uh, on the positive side, they had plus 24p from rental increases. So really, you're talking about a 17p drop in the NAV. And I mean, I think what you've got to do is you've got to look at these numbers relative to like how much this share has dropped in price. So if we say over 1 year, like 1 year ago, this was £8, it went up to £9, and is now below £5. So over the past year, it's lost 17p of NAV, but the price of it has dropped by 300. So a drop of 17 has caused a drop of 300 or 400 from its highest point, which was here. Okay, which obviously is a lot, isn't it? I mean, that's like 25 times, I think, 25 times the amount of the NAV movement. Yeah. Like common sense tells you if something drops by 1%, should the price drop by 40%? Well, no, probably not. It should drop by about 1%. Do you see what I mean? But obviously we've got to look at the income side of it as well. Ultimately, what are these assets going to generate for me in the future? So we'll talk about that as well. But a lot of this negative 41 pence, as you can see here, I mean, that's not going to happen again. That's not going to happen again. That's not going to happen again. Fire safety is sort of going to happen for the next 3 years, they reckon, until 2028. But that again is sort of a limited amount of time. I'm not going to say limited life because that's obviously quite black and dark, but you know what I mean. It's sort of a finite factor, development costs. So quite a lot of that minus 41 is sort of one-off in nature. So then you've got this 30 pence due to the three cities, and this is all to do with the fact that there's a proportion of the estate that are in what's called low tariff cities, and they're going to dispose of those and focus in on high tariff cities, so it's sort of, when you look at it like this reduction in NAV, first of all, it's very small. We're not talking about a reduction in NAV of 40%, which has caused the share price to drop 40%. But more than that, it's one off, and more than that, it's sort of very limited impact, into specific cities. So when you look at, this is sort of the same thing, sort of seeing it a different way. So the 17 pence difference from here to here, quite a bit of that was down to sort of one-off factors. Some of that was down to the three cities that had lower levels of um, utilization, but offset that against, that they had a growth in the valuation of their portfolio of 3.3%. So even in a tough year, they had a 3.3% increase, and in past years that increase has been far stronger. But this year it was net negative, and these were the reasons why. So really, it's three cities. It's Leicester, Nottingham, and Sheffield. Weaker demand combined with new supply meant lower prices. So what are Unite doing about this? Well, a third of the holdings in these three cities were disposed of at 1% below book value, which 1% below book value of 972 would have been what, 9 963, something like that, 1% off that number there, about 10 pence off that number. So above what it is today, which is interesting. So 1% below book value, 142 million was disposed of. So it wasn't disposed of a 50% discount, it was disposed of at a 1% discount. 10 properties. I mean, there was something in Aberdeen as well, but you can see, Leicester, Nottingham, Sheffield, the three, and then there was Leeds and Aberdeen as sort of other areas, but the bulk of it were from these low tariff problem cities. So what Unite have also done is sort of basically introduce a price promise. They've introduced will rent you, we'll give you your student accommodation for 44 weeks rather than having to take it out for 51 weeks. So you're not paying for the whole year, you're paying for term time essentially. So that's going to sort of reduce the income by 14%, but should drive levels of it should make it more attractive, because compared to other options out there, I suppose, like students can look at that and go, well, they're offering me 44 weeks, that's better than paying for 51 weeks elsewhere. And with HMOs, typically they'll want them to do sort of multi-year potentially. So I guess it's the bird in the hand's worth two in the bush argument. For the stuff that's sort of not worth as much, let's see what we can get for it. The operating profit, this actually grew by 15 million. Um, and you can see it here, the net operating income. So organically was 15 million higher. The non-like for like was the new property that they added to the portfolio. So there's a very active additions program that they're doing. And what they tell us about is that there were these costs that got added in. But when you look at these additions, I mean, you saw earlier on the 5.2% net operating income yield, 5.2. So that's kind of like the return on investment. So when there's new stuff that's at 8.1%, that's far higher than the 5.2 of the existing stuff. So for me, that's a real sign of positivity that they're adding stuff that's worth more, that's got a higher yield. So that for me was a real positive. Um, and that grows the NOI. It's also the case that these new buildings were at the 7% forecast yield, or sorry, any further ones are on a 7% forecast yield on cost. So yield on cost rather than yield on net operating income is essentially, again, it's the same principle that the stuff that you're adding, the future stuff, is coming on board at 7% at a higher rate than the existing stuff. So therefore, there's an overall gain. And there's a pipeline worth nearly half a billion in the pipeline over the next years. 4 projects, 6,000 beds in Newcastle, Manchester, London, and Glasgow. Again, at that 7% forecast on yield, which is that number there. So that's the committed pipeline. The underlying profit. So the underlying profit. So this is sort of, there's the adjusted earnings. Again, the growth of those earnings was substantial. So when you look at the bridge between last year when this share was at £8 and it made those adjusted earnings 46p versus this year adjusted earnings of 47p, again, doesn't really add up, does it? That why is this now sort of nearly half the price, yet it has increased its adjusted earnings, which again I thought was very impressive actually. Operating profit per share. Now, what's happened is they've merged or acquired Empiric. That means that they've issued more shares, but they're also engaged in buybacks. So that means they're reducing the number of shares. So the operating expenses have been growing. As well as the profits. So the rental income is growing, the expenses are growing, but the operating income is growing, or the rental income is growing faster. So operating profit is actually higher than it was 5 years ago when the price of the share was double what it is today. So what you see here is what I've done is I've just converted it back into how much pence per share does the rentals deliver. Now, this doesn't include capital gains, capital losses, but this is the rental element of the business. And you can see that's where I'm getting that 10% from, is that it was 33 pence, it dropped to 32, rose to 34, rose to 36. So that part there is the cost of sale and the operating expenses. That part there is the rentals. And then this part here is the other income, which is then sort of like joint venture profits and other things. So growing profit per share for its rentals, again, doesn't really add back up to the drop in share price. 2026, the forecast is for about 42 pence increase. And that's a 13% increase in 2026. That's partly down to Empiric, the acquisition of Empiric. Obviously, they were going to earn more from the Empiric properties, but also from further rental growth, also from development completions. So this 475 to 485 million rental income outlook that they gave, that's where I'm getting that 13% growth number from. It's also the case that domestic demand at high tariff locations has risen. Uh, Applicants have risen by 6%, and the propensity to take out student accommodation has increased by 8%. And there are people who are saying that the demand has been destroyed or the demand is dropping. Absolute cobblers, like according to this, absolute cobblers. I mean, yes, if you've got a load of property in low tariff locations, then yes, the number of applicants is down and the number of people looking to use your facilities is down 3% in this case, but not in the high tariff. And the majority, 67% in the case of Unite, is in the high tariff locations, and then so is in the medium, minority is in the low. So there's the UK also remains as top location for overseas students. 400,000 chose the UK. What the UK have done is sort of basically say you can't bring your family. Like if you get a visa to come to the UK to study, it doesn't mean you can bring your wife, your mum, your cousin, your dog, whatever. Like you can bring yourself, and that's it. Which I think personally is fair enough. Like I, I don't know why anyone would want to bring their family with them when they went to study somewhere. You go to study somewhere. I think it's bizarre that there's an expectation that you should be able to bring whoever else along with you. No, they're not coming to study. You're coming to study. I mean, they can go and apply to study somewhere as well if that's what you know. But anyway, um, so I'm saying sorry, mum, you're not getting a visa as well. But the UK, I mean, second to the US, of course, but the US, of course, has got very um, has introduced some quite punitive measures. Let's put it that way. So you can see the USA, this grey line has dropped, whereas the UK has actually overtaken the US and is larger than Australia, larger than Canada. So the UK remains the top, or is the top destination after sort of losing its crown, as you can see here, to to Canada back in 23. The UK now is the leading location. So it's also the case that Unite there's a synergy to why it's acquired Empiric. One of the synergies is that Unite is well geared to attracting overseas students. It has a 24/7 call center. Empiric didn't. It has an office in China. Empiric didn't. Chinese speakers, a virtual sales team, which were all things lacking international social media. So lots of reasons why that will drive better levels of engagement, better levels of of utilization of the property. But I mean, we may not see all of this benefit in 2026. It may be in 2027 that some of the benefits of this come through. I mean, that the acquisition only finalized in January of this year, so 2 months ago or 6 weeks ago, and yeah, the integration is carrying out in 2026, so the full benefit will be in the 2027 2028 sales cycle. By the way, the sales cycle, it's interesting. Whilst the financial year will of course run January to December, the academic cycle runs from September to June or July. So it's the 27-28 is the idea that you would recruit for students that are going to actually take out your accommodation from September 2027 to July 2028. So the financial results will sort of not follow the academic results or the academic levels of attendance. CapEx, so two-thirds are in high tariffs, as I already said, so 72,000, 67%. They're looking to move that towards 80%. So again, that move towards quality is very much, and that's going to be achieved through disposals, through partnerships, and through further development. That let's not bother with developing for low tariff cities. Let's develop for high tariff cities. It's also the case that the new Renters' Rights Act is coming in to the UK in 2026, that will cause many, I think, to exit the HMO market, that there's all sorts of rights that renters get. Hence, the clue is in the name. Um, and Yeah, that's also the case. And let's sort of move down into the new supply is slowing. So obviously there are still some projects that are finalizing, that are still being built, but in terms of new supply of property, it's dwindling, and 80% of current, well, at least sort of looking at the portfolio of Unite Beds, 80% of it just wouldn't get built, wouldn't be viable to build today based upon current prices and the cost of building property. So again, that's another factor. It's also the case that occupancy was, a couple of years ago, was at 99%, 99.8%. Obviously, that was back when share price was £10 a share. 68 is the fact that it's not yet the end of the recruitment cycle for the academic year. Obviously, we're in March. The start of the academic year is September, so they're recruiting for September. So it's at 68%, which is actually below where they were a year ago, but ahead in terms of the direct lets. So some of it gets let through universities themselves. Will take on some of the beds for what they call nominations, which is essentially they will provide those to their students. So it's like the the universities get a discount from Unite, but then they guarantee, essentially they pre-buy the capacity. So they're looking at something like 93 to 96% outcome, which will still be a growth of +2 or +3%, and at worst that will mean a 0% year on year, but potentially a 2% rise in income. And then that excludes Empiric. So Empiric adds probably about a 10% addition to that as well. So again, there's a benefit there. If you actually look at the lost revenue, so this is looking at the EPRA rental value potential of the properties, that the occupancy level is costing, inverted commas, Unite about 15 million. So it's more than it used to cost, but the lost revenue through discounting through the so this is the APM, the alternative performance measure, which they said had grown from 320 to 321, whereas the statutory rentals had grown from 282 to 307. So this difference here is actually far, far lower relative. And again, I don't think the market has understood any of this, that difference there of about 13 million is less than, it's about a third of what the difference was 12 months ago, which doesn't make any sense to me. So that, because this number here is the potential rent and this number here is the actual rent. Well, they've achieved far closer to the potential. If we look at it from the balance sheet point of view, we're always through the presentation here. If you look at the assets from a balance sheet point of view, now they are doing buybacks. So what I've done is I've removed 50 million of cash from the numbers, and I've obviously sort of taken the latest number of shares in issue to work these numbers out. But what we see here, sorry, let me just move myself. There we go. So what we see here is that if you take the balance sheet at the end of 2025, so you've got, and bearing in mind that the Empiric numbers only happened in 2026. So at the end of 2025, those numbers there you see in the first column don't include the balance sheet for Empiric. So what I've taken is the latest numbers from Empiric, which were the ones at the end of June, added them together to get me to that number there. Obviously, all I'm doing is taking column A, column B is the combined. So what we're seeing is that you're getting a business that owns 5.3 billion of property that you own. 60 million of property rights that you lease. So you don't own it, but you're leasing it, and its right of use value is 60 million. You've got a pipeline of properties that you're building that are worth 446, work in progress. You've got joint venture properties where your share of the properties are worth 1.3 billion. You've got other, which is basically cash and tax, deferred tax, or basically any other assets, any other current assets, 72 million, and add all of those together, and you've got 7.26 billion of assets. You've Oh, actually, sorry, no, the 72 million isn't the current assets. Current assets are there, 200 million, so that's the cash and stuff like that. I think that one might have been goodwill and intangibles, whatever. Right, 70. I mean, it's not a material amount of money; it's sort of less than 1%. So you've got 7.5 billion of assets. You then owe debt of well, so basically all of your liabilities are sort of close enough 2 billion. So essentially, this company is worth a net. So you've got 7.5 billion of assets, 2 billion of liabilities. So you've got kind of something that's worth 5.5 billion, which, as you can see over here, is worth £10.23 per share. Now you can buy. I mean, you could have bought Unite this week at £4.91. I think I was the lowest I paid this week. I'm paying less than half price for something that, as far as I can see, has got a couple of one-offs going on, has got a couple of rubbish cities that it's exiting out of, that it's got an exciting pipeline of high tariff, 500 million of high tariff work in progress that will be about probably, I don't know, 20-ish% once it's fully built. So it kind of replaces and adds to the assets up there, that's generating rising levels of income, and you're getting it for less than half price. I mean, and people are not going to stop going to university because there's a war on with Iran. Uh, it's pretty defensive as far as that goes. I mean, yes, you could sort of end up with a lower level of intakes, or the number of international students could reduce because of a prolonged war and an economic depression and bum 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 bum. But even if that does happen, I mean, longer term, this will bounce back anyway. So I just, I don't know. I think fundamentally it's mispriced. I mean, the chances are that the Iran war, is not something that's going to remain highly kinetic for a long period of time, because the Americans likely are just too powerful, that they will just squash any resistance from Iran, and that I think the war will sort of dwindle away to something quite low level quite quickly. And so, yeah, I think, to conclude, that when you look at this from a balance sheet point of view, it's impressive. When you look at it from a growing income point of view, it's impressive. When you look at it from a strategy point of view, I mean, it is the sort of go-to leader for student accommodation, and export of the invisible export of education remains a key British industry that we're good at. So, uh, quite why it's priced on such a discount is a little bit beyond me. But other than to say that it's just got caught up in a wall of negativity, when yeah, intrinsically it's worth more than its current share price, as far as I can see. So anyway, that concludes what I was. I think that concludes what I was going to cover. Yeah, I mean, the rental EPS of 41p to 43p on £4.95 is sort of 8%, 8.5%. The longer term sort of value of property, the 100 million buyback should lift the NAV by about 2%. And then longer term, I mean, property will, like, you'd expect property to rise naturally, like the value of land, the value of the property to rise over time as well, maybe by 5%. So you've got that strong PBSA demand. You've got all the problems with Renters' rights, HMO, you've got that huge discount for no good reason as far as I can see. You've got that buyback that's going on, and you're buying back stuff at like 50% discount. You've got the development pipeline and also the cost savings. I haven't even mentioned those, but there's 24 million of cost savings coming from Empiric, and reduction of central costs, admin costs, and that's equal to about 4.5 pence per share. 7% yield or 8% yield, 7% yield on new properties, 8% yield on refurbs. Debt is costing you 4.3. So again, when you look at the difference, you're making a profit on the leveraged portion of this. And yes, debt's currently 4.3, is going to rise to 4.7, but that's still below that magic number of 5.2, and certainly below the 7 and 8. It's got a low level of loan to values. It owes about, I think it's 27% LTV. So it's not heavily indebted. It's as you can see, you've got a large amount of shareholders' equity, 7.5 billion of assets, and 2 billion of liabilities. So you own part of 5.5 billion of assets. Earnings per share 41 to 43p. The earnings per share outlook looks stronger as you look ahead to 2022. Disposals program, I mean, if they sell off 300 to 400 and then recycle that into 7%, 8% yielding properties, again, it's all positive. So anyway, none of that's advice. It's just and you make your own investment decisions, but hopefully that gives you a perspective on what was sort of, given a pretty lukewarm reception. I think it looks far more exciting as far, well, I mean, it's not exciting. It's quite a boring share, but it's one of these sort of, steady Eddie shares that um, is mispriced as far as I can see, and pays a strong yield as well. I mean, the dividends on this, so 2.7 billion market cap. So yeah, 37 pence on £4.90. So you're looking at about a 7% yield as well. So that's another um, benefit to this as well, is that it pays a tasty dividend as well. Anyway, that's enough from me. Hope that's been useful, and thank you for watching, and cheerio for now. Cheerio.